Welcome to the Big Mike Fun Podcast, where you learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike.
Mike's enlightening, and today it is my pleasure and a privilege to welcome Rob Scranton. Hi, Rob.
Hey, how you doing, Mike?
Thanks for coming on a podcast. You hail with a wonderful website. We'll talk a little bit about your business later. We'll start with the family, but your website is yourfinancialiq.org, not to be confused with .com or .net.
Yeah.
And tell us a little bit about Rob, where you live, family, kids, cats, pets, anything that works for you.
Yeah, sure. I've got my wife, Robin, and I've got three boys. We got quite a range. We have a senior that's going to be graduating this year. He's 18, a 15-year-old, and then we've got our 4-year-old. So kind of our tag along, I guess, at this point. But it keeps everything fun and lively, and it's made life interesting for sure. So
That's awesome. God bless. And where is home?
Oh, yeah. Sorry you asked that. Yes, we live in South Jordan, Utah, a suburb of the Salt Lake City area, and love the outdoors and all the national parks. We got 5 in this state. Don't tell anybody because we don't going to get even more overcrowded than it is because it is so beautiful. And we love skiing and just all the activities that there are here. So it's been a great place to raise a family and to live.
Yeah, beautiful part of the country, and it's a great for if you're I guess an outdoor enthusiast. That's a great place to be for sure.
That's right. Yeah, for sure.
So let's talk a little bit about what you do. And what intrigued me, you said that you help folks turn their expenses into wealth building. So talk a little bit about that. Let's start with the basics and then kind of dive into, because ultimately what you offer is infinite banking. We've had other guests, but on the podcast to talk about this, but you have a different angle. You do things a little differently. So we'd love to hear, how do you help folks turn expenses into wealth building?
Yeah, that's what we talk about. How to use, your debts and expenses that you already have to grow your wealth. And it is kind of a strange concept to people because they're used to having to scrimp and save and delay gratification and deny themselves things as their mind. That's why a lot of people don't do it, right? Save or invest, for the future down the road. But we have a training where we show people how to get back all the money for all the cars that they're going to buy, drive, and own for the rest of their life. And we use math and a lot of detail to show exactly how we do that. In fact, I've got 3 cars sitting in my garage right now. I've got all the money back for every one of those cars I bought. Plus, I still have the cars sitting in my garage out there. And that seems fantastical until you look at the math and see how it's really possible. But that's one of the things I always ask when I go on podcasts is ask the listeners to ask themselves, how much of the money have they ever got back for any of the cars that they've ever, bought, driven, and owned over the course of their life? And probably the answer is none, right?
Cars are depreciating asset, and they have its expenses, insurance, obviously, upkeep, loan payment, if you have a lease payment. So how do you do this? Let's just go dive into the depth. So folks have heard of the infinite banking. It's a whole life policy, typically overfunded. Just explain how folks do it. They set up the policy, they overfund it, and then they use the policy to finance some of these expenses. And then at some point, the money comes back. I'm just curious on the mechanics. Just start with the basics. What is a whole life policy? But don't go too deep on this because folks have talked about this. So whole life insurance policy that enables you to add more cash than just the minimum death benefit. So it's kind of a savings account in a manner of speaking. But talk a little bit about it.
That's the way sometimes people think about it. It's like a savings account that comes with a bill. So you're more likely to pay that, because savings always sounds like, oh, that's optional. Maybe I'll do that this month. Maybe I'll do it next month. Maybe I won't. but if it's automated, it's much more likely to happen. So yeah, I mean, it's kind of the unique aspects of these particular policies. They've been around for over 200 years, so we don't have to guess about how they're going to work or how they're going to turn out. So it's very predictable in all those senses. And we can only use, anybody can write you a life insurance policy or a whole life insurance policy if they have a life insurance license. But we specifically design these to work for the infinite banking concept. And most people, when they've shopped for life insurance in the past or been sold life insurance, usually they're looking to get the most amount of death benefit for the least amount of premium that they possibly can. Almost all of us have had a life insurance conversation with somebody in that regard, whereas we're kind of we're solving almost for the opposite. We're trying to get the least amount of death benefit we possibly can for the most amount of premium that we possibly can. And we can only do these with mutualized insurance companies where the policyholders are essentially also owners of the company. The company was created for the benefit of the policyholders, very similar in a way to if you think of like a teacher's credit union, where the credit union was created for the union members to have really good banking access and so forth. So as such, when the company profits, the policyholders participate in the profit of the company in the form of a dividend. So that way, you're getting paid a guaranteed interest rate, but you're also getting paid dividends. And there's this very unique feature of this that a lot of our real estate clients love using this banking system because over time, you start building up the cash values inside the policy. You're getting paid that guaranteed interest rate. You're getting paid dividends. And when the company, charges more premium than what the actuarials based on the actuarial tables, then what they paid out in death benefits, they also return part of that premium to the policyholders as well. So you're kind of getting paid really in three different ways. And over time, that constant compounding, everybody talks about compounding interest, but very few people ever do it because as soon as you take money out of your bank account at Wells Fargo to pay for a car, if you want to pay all cash, you stop earning interest on that money at Wells Fargo. Whereas with what we're doing, when you take a loan against the policy to purchase that car, you're not actually taking the money out of the policy. What you're doing is you're taking a loan against the general fund of the insurance company, using your insurance policy as collateral. And so therefore, you never stop the constant cash growth accumulation compounding inside the policy, even for one single day, while you're, saving on the interest rate of what you would have paid to a finance company to buy the car, or say invest in a piece of real estate, or make a hard money loan to somebody for 6% for a month. Even while you're doing that with that money, you never stop earning on the dollars inside the policy while you're doing that. So it really allows you to earn, a rate in two different places at the same time with the exact same dollar. And those kind of features and benefits just don't exist with any other financial tool or instrument on the planet, at least not that I'm aware of. And if you know something, Mike, please let me know because I've been looking for 14 or 15 years and I haven't found it yet.
Yeah, I appreciate you sharing that. Certainly, there are different things to invest, the different ways to invest, but this is a way to invest in sort of your own, becoming your own bank.
And it's a multiplier because no matter what else you're doing, you can earn in two places at once.
Well, let's understand that. So you deploy, you buy a policy, you jam in your cash into the policy. That cash earns. What does it pay? 5.5, 5.25?
Yeah, that's typically the
internal.
That's typically the internal return, and that doesn't sound that attractive or exciting or sexy in the beginning, but it's that compounding effect over years where, maybe you're making 5.5% on $100 this year, but the next year you're making 5.5% on $105, and the next year you're earning 5%, and so on and so forth, to the point where 10 years from now, we're often seeing that people's cash is growing by double what they're making in premium deposits every year.
Yeah,
and
this,
that's
of
all
course,
guaranteed.
this is compounding. And there's nothing too let's just call it not sexy at 5.5%. Maybe today's environment, when the rates risen and the banks are paying, on CDs, that kind of interest, that doesn't look as attractive. But a couple of years ago, when the banks were paying, 0.5%, the life insurance policy payments or growth of the cash at 5.5% plus minus is certainly comparable. Plus, its money is considered to be safe. Best way the way I think of this is it's relatively safe. These life insurance policies have been around for a long time. They're probably way safer than a bunch of banks that are out there that have had problems and the government to take over and all that the good stuff. But where do you earn money twice? So you earn the money within the policy, right?
Right.
Then you can borrow against the insurance company general fund. You're not really borrowing against the policy. The policy secures the loan, right?
That's
So
right.
that's why they'll give you the loan. They're not going to underwrite you. They're not going to go through credit check, none of the stuff. If you have a cash balance in the policy, the insurance company will give you the loan against the policy because they have no risk, effectively. And then what do they charge? What interest rates do they charge on that loan? And how does it compare to you getting a car loan? I'm just curious, just using a very simple scenario. Where do you earn twice?
Well, my neighbor across the street just went and got a car loan on a Jeep Grand Cherokee, and the best they were able to get was about 8% interest. Where when we borrow from this, typically I think the rates are right around 4.75% when we borrow. But if we're earning at 5.5%, we're creating a hedge right there. But it's actually much better than that, because while we're earning that 5.5%, if we had $100,000 cash value in there and we borrow that out to give to a home flipper that promise us a 6% return for the use of the capital over 60 days. So we're earning that, and we're still earning that whole 5.5% on that entire 100,000 inside of the policy itself, even while we borrowed that out. And I think that's just a hard concept for a lot of people to grasp, because they've just never heard of that and never experienced that ever before. And so while we continue earning all that inside the policy, again, we don't stop the cash growth, accumulation, compounding, even for a single day while we're borrowing it. And they're making that hard money loan to a flipper. He flips that property in 60 days. We get the whole $100,000 back, and we put it back into our policy, replenish that, fund, that war chest or wealth, opportunity fund, whatever you want to call it. And we get paid the $6,000, on top of it. So we've really earned on those dollars twice in that 2 months. And that's just a very unusual thing to be able to do.
Yeah, I appreciate that explanation. So the way I'm hearing this is that you borrow from a policy, the rate somewhere around, you said 4.75. I've heard of the 5%, plus minus a little bit, but let's just call it 5. And you can loan the money at a higher rate of return, and you're creating arbitrage between what you're earning on that money versus what you're paying the life insurance company on the loan, right?
Yes.
So it makes sense. It's arbitrage. Of course, there's some risk, right? I mean, it's just not a risk-free exercise in essence. The fact that you are loaning on a fix and flip project or whatever the hard money rate, 12%, 13, whatever the number is, and you're paying 5, that arbitrage, it's arbitrage for the extra level of risk that you're taking between essentially sort of the zero risk bank loan to you, right? Versus you're making a loan. Hopefully you underwrote that loan well. So understood. So you're earning arbitrage because you're able to borrow against the policy and deploy the capital. And your option number 2, instead of investing that money, you could actually buy the car, right? And effectively, but in that exercise, you're also earning arbitrage versus, you said, borrowing from a bank on a car loan at 8%, which is your opportunity cost, which you would otherwise pay to borrow that money, versus it's actually costing you at 5%. You're creating arbitrage again. It's just a different arbitrage. One is investment arbitrage, the other one is saving arbitrage. Am I getting it right?
Yeah, no, that's pretty good. And on top of that, I think the thing, and that's just year one when we're making that comparison, in year one, why is this a good idea? but that compounding effect, as years go by, gets significantly better even. I mean, some of my older policies are 14 years old now. I get my annual statement. It shows that $10,000 deposit that I made, and it shows the cash value growth of $18,500. So that's 185% return on the dollars that I get back. So when I look at the cost of borrowing at 4.75, 5%, 6%, even if it was 10%, do I really care when every year I put those dollars in and I see that I get back 185%? It'd be like, Mike, if you gave me 10,000 and I gave you 18,500 back immediately, do you really care whether it's 4 or 5% that you had to borrow that against? Because the spread is so incredibly huge, at that. It's just fine and we're happy with it year one, but as the years go on, I mean, it just gets unreal. I said I wouldn't tell stories, but so I'll stay away from that. When my dad first showed me this with a policy that he got on me when I was a child, just a standard whole life insurance policy. So I saw it. I had it real in my hands when I was first investigating this and said, wow, okay, this is actually 100% true. I've got this 30-year-old policy that is in my name that my dad's been paying on, and I can see, how this works. And that was, really helpful when I saw a real example with policy with my name on it to completely understand what was going on with this.
Yeah, Rob, I appreciate that. It's just what you just described as a power of multi-year compounding and a forced savings, right? So the policy acts as a forced saving mechanism because it's a still life insurance policy. You have to keep making annual payments.
Yep.
So it forces at least a minimum. You can do more than a minimum, obviously, depends on the policy, but it forces automatic savings. And then as the savings account grows with the compounding, as you're saying, you have ability to borrow, you have ability to use the borrowed money to invest. You don't need to go through the bank underwriting. So the power of compounding is just tremendous. And this story, again, that's near and dear to your heart is the fact that it's been done to you by your dad over many years. And that works. It works by the way, it's true with life insurance, it's true with college savings, it's true with any kind of savings. If you can systematically, programmatically save and invest and do it well over time, it works, right? So the concept is obviously very powerful. And in general, some folks compare this to because there's opportunity cost. At the end of the day, if you do a lot with a life insurance policy, that's wonderful. But also you have an opportunity cost. Can you deploy the money somewhere else? So it's kind of like if you're sitting on cash, you could put it in stock market, you could put it into real estate, you could put it into other things. But what I think you referred to is a lot of real estate people, they'll jam the money in the policy first, then they borrow against the policy, then they'll do their real estate deals, loan the money, do something else.
That's right.
They're able to basically do their business without losing a lot of cash. And so typically when folks invest in their policy, properly structured, of course, how much cash can they borrow against the policy in year one? If they were to put $100,000 in the policy, can they borrow $100,000 in year one? It's usually the reduced number, 80%, 85%. Is that about right?
That's right. Yeah. So, Mike, and we always have to go back and compare it to just a straight whole life insurance policy compared to what we're doing with a traditional whole life insurance policy. If you were to get $100,000 a year annual premium policy, you would have $0 of cash value year one, $0 in year two, maybe enough cash value in year three to tip your barista at Starbucks, and you might start seeing some cash, start to accumulate in there by year four. So when we compare it to that, yes, in year one, you'll have approximately 50 to 60% of the premium deposits available to borrow in the form of loans. Year two of that premium, approximately 80, 85%. And by the time we get year three, year four, somewhere in that range, that's when we start to see that tip in our favor, where we're now seeing that we're having more cash value available than the premium deposits that we're making in there. And it just starts getting better and better from there. They have to hold some of that back because we're doing this infinite banking system, but there is this little cherry on top. We often don't talk about this death benefit, and they have to pay for that. In case somebody were to do something silly like die in the first 6 months of the policy, so they have to hold some of that back, initially. But I always think of this banking system as not well, I could do the infinite banking, or I could put this into stocks or 401k or into real estate. Think of it more of as an and. Whatever you do, you're going to be far better off, whether you're paying debts or expenses or investing by running the money through your banking system first and then doing whatever else you're going to do. Kind of like a credit card. A lot of us, that are business owners at one time, we had our income came in and then we paid all our bills at the end of the month. And one day we had this epiphany that if I use one of these cashback cards or an airline mileage card, I could advance myself, just by adding one more step into what I'm doing and, getting my income and then paying each of those bills with my credit card and getting all those miles. And at the end of the month, just paying one bill. So I don't misuse my credit and, end up paying interest on it and so forth. But by just adding that one step, now I've got all these miles, I could take a free trip or I get the cash back because of it. And we think of this as sort of the same thing. We're just adding one more step into our financial life and creating a significantly better outcome with what we're doing. Plus we have this bonus, added cherry on top of this death benefit to protect our family sometime, in 20 or 30 or 40 years on top of it.
Yeah, of course. And I appreciate you mentioning the death benefit. At the end of the day, we're all mortal. I mean, death and taxes, right? Life insurance is designed to address both of these issues. What's really interesting is the benefits are typically to the heirs, to the family, are tax-free, right? And because you usually at least it depends on how the policy is structured, but most of these life insurance policies provide tax-free benefits to the kids. And then at the same time, it's a savings bank. So it's a very powerful technique. And at the end of the day, like you said, it goes back a couple hundred years. So what new things have happened in the industry in this front? So this is what you're talking about is absolutely a good idea. It's a good way to customize the policies. I've had other guests on the podcast that speak very, very similarly, the same ideas. So how are you different from other folks who do this? Number one. Number two, what has changed in the industry? Has there been any innovation? Because the concept has been around. People talk about it, and once in a while, every year, somebody comes in and talks about this. And again, it's still good. A year later, it's still good. A year later, it's still good. It still works. It's a very steady, kind of a permanently consistent, conservative way to put your dollars to work. So no argument there. But again, what's new in the whole world of life insurance, whole life? And then what are you doing different versus other folks that do things similar with this infinite banking, overloaded saving side of the policy versus the death benefit?
Yeah, that's interesting two-part question, Mike. And I would say, to me, that's really the strength of what we're doing is that there hasn't been anything changed. It's once they discovered what absolute mass was, scientifically, that hasn't really changed or gotten more sexy or interesting since they discovered that. And this whole life insurance policy, they've essentially stayed, very much the same for those 200 years that they've been in existence. And so they're very predictable. We know exactly how they're going to work, how they're going to change. Sometimes people will come out with some new whiz bang, sexy thing or approach, but it's interesting. Like, in Nelson Nash's book, he talked about that universal life policies cannot be used for the infinite banking concept. And interesting, I get those kind of questions all the time. And interesting, the company that invented universal life was a company called E.F. Hutton. And they used to have a tagline that, when E.F. Hutton talks, people listen. But I guess people aren't listening anymore because E.F. Hutton went out of business and they were the inventor of that. So people are constantly trying to come up with new, fancy, sexy things, and they drift off and go by the wayside and so forth. And as far as what we do, I had worked with other companies in the past that did this infinite banking concept. But what I didn't like is I kind of felt to a certain degree we did a lot of education and teaching people on the front end what infinite banking was, and then people would get their policy, and that was kind of it. We were sort of encouraged to move on to the next, client. And I work with a company now that we're partnered with called the Money Multiplier. That I love their level of education that they help clients with, and ongoing education, and then the support we're able to provide people long term, so that when they get this banking policy, of course, it's new to them. It was new to me when it was new to me, and we don't necessarily know. We know enough that we decide we want to do this, and this is an important, financial tool that we should have in our lives. But as far as the practical application of the concepts and executing the steps to make it work and make it happen, I think a lot of people, we've seen get these banking policies, even if they were designed exactly the way we would have done it for them ourselves, but people kind of freeze in inaction because they're afraid to make a mistake or do something wrong. And of course, it is money after all, and nobody wants to make a mistake, with money. So they kind of freeze in inaction and do nothing, and then they're not using it for the banking aspects, which kind of defeats a lot of times the whole reason that they set up this banking policy in the first place. So we really feel like when the policy goes in force or in place, it's not when our work ends, but that's when our real work begins. And we demonstrate in that video we have on our website, kind of a free masterclass to show people how to get back all the money for all the cars they're ever going to buy the rest of their life. But we also show them the map, the money multiplier map that we'll build for them, where we put all their debts and expenses, or even potential investments in there, and their banking system. And we have a specific mentor assigned to them to walk them through even how do you take out a loan from your policy. And then when it's time to start paying that back, how do you get the money back into the policy, the practical, steps, the mechanics of actually doing that. And that's something that we work with our clients to update that 2, 3, 4 times a year, because they're going to buy things and sell things. And so their debts and expenses are going to change, and we want to make sure that their action plan or their spreadsheet is up to date at all times as well. So there's not very many companies out there that do that or provide that level of service for their clients. And like I said, I've worked for 2 or 3 other companies in the past. I just haven't seen anybody else that does it anywhere near as well as what we're able to provide people with. The money multiplier is kind of the backbone of what our company does in helping service clients that way for the long term.
Yeah, I appreciate that explanation. You help them with, I guess, some financial planning in addition to, obviously it's a tool, and you're just helping them use the tool and understanding how to use the tool better and all that stuff. It makes a lot of sense.
Yeah.
Quick question. So do insurance companies mind if you borrow, repay fast, or is there, if you do more than 4 loans in a quarter, are they going to get very upset? I'm just using an example. Just give me some.
That's a really good question.
Probably insurance company doesn't mind, but if you keep asking and borrowing, repaying, it's not a demand deposit with a bank. It's insurance company, right? They're just curious.
Right. No, that's a really good question, Mike. We talked about before, there's over 1,000 life insurance companies in the United States that will write insurance policies, and anybody with a life insurance license can write you a life insurance policy. But the most critical important step of this whole system is how that policy is designed, and whether it's designed and optimized specifically for the infinite banking concept, and who that policy is written with in the first place. Because if it's not, it ultimately is not going to perform the way people are expecting it to. And there are certain companies that like I said, we can only use mutualized insurance companies for this banking, concept. And of those, there are certainly companies that are not very friendly to the infinite banking concept. They make it they make it difficult for people to take out loans. Like they won't let people touch the cash value for a year, or in some cases 2 to 3 years. And we're telling people like, hey, let's get that policy in place, and let's have you meet with your implementation specialist and create a strategy. Let's start using the dollars inside there for the banking aspects, immediately. By immediately, we mean within the first 30 days. And obviously, if there's companies that won't let them touch that for a year or 2 or 3 years, and they're kind of not very, they frown upon people taking out all those loans, that's going to make it a lot more difficult for the client. So all the companies we work with are are very pro infinite banking. They really assist our clients and help them, and don't put those restrictions on them using it, or how many times they take loans and pay them back and take them and pay them back. They don't have those kind of restrictions on there. So we'll make sure that we put them with a company that will be friendly toward them utilizing the infinite banking concept, because we want happy clients that are able to do what we're teaching them to do, of course.
Rob, I appreciate that. Yeah, of course, company selection is critical. I mean, obviously, in the features, functions, and ability to borrow, which makes a lot of sense. Thanks for sharing all the wisdom. How would folks get a hold of you? Obviously, you mentioned yourfinancialiq.org. Is there any other way, or any final thoughts? Just
I guess I'd be happy even to give people my cell phone number. Please don't call me. I rarely answer phone calls, but you can text me and say, hey, I heard you on the Big Mike Fund, Rob. I'd like to connect. My phone number is 309-737-1534. I love talking to people about this and helping them set this up for their family and their future and their legacy. And like you said, if they just would like, at this point, a free training, we have our master class about everything infinite banking on yourfinancialiq.org. And they can also schedule a call right from the website if they want to connect more. That's a great way to do that too.
Thank you for sharing. Thank you for coming on the podcast. Appreciate your wisdom, and good luck with the infinite banking. It's the good old.
Thanks for having me on, Mike. It was a good time. I always enjoyed talking about this. So
thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.